Good afternoon, everybody. We are Team Excellence Warriors, and we are from India, the Indian School of Business. That's Rahul Gupta, Raghav Jindal, and I'm Akriti Bhalla. So we all started the School of Business in April. Prior to that, I was working in McKinsey and Company in the India office for 2.5 years, and then with the Bill and Melinda Gates Foundation for a couple of months before I joined ISB. So mostly done consulting.
Hi, Raghav Jindal. Before joining ISB, I was actually working in New York in investment banking for an Australian investment bank called Macquarie Capital. I worked there for about 5 years in their mergers and acquisitions team, so I have a finance background and decided to come back. My parents live in India, so saw an opportunity to make our future in India and decided to come back and join the Indian School of Business.
Good afternoon, everyone. I'm Rahul Gupta. I was working with Ernst & Young for nearly 2.5 years in their business advisory division. The major industry that I have focused on are life sciences, constituting of pharmaceutical and healthcare practices. That's the that's the work experience I have, and after that, I've been in ISB since April 2014.
Okay. Thank you.
So, what we understand based on the reading and the secondary research that we have done, the problem Slovenia is the third most forested country in Europe after Sweden and Austria. So basically, they have 58% of their territorial cover as forest. They have abundance of resources when it comes to forest. Still, Slovenia has not been able to get those expected return on assets which countries like Austria and Finland have been able to achieve. The question that we are trying to answer is why? Why we haven't been able to achieve that? The two issues that we think will be imperative to answer would be the inefficient management of utilization of Slovenian forest resources, plus the inability of the Slovenian government to control the timber markets in times of uncertainty and high volatility. So these are the two questions which we'll be answering throughout our presentation.
Given this is what we identified as a problem statement, we did a little bit of analysis of the timber and forest management industry in Slovenia across a couple of factors. So the first factor, we looked at the economic factors, and we saw that overall the industry was growing. It had a CAGR of 2.29% from 2001 to 2009, and there was just a dip because of financial crisis. Also, the demand for timber in the world is rising, not just in Europe but also in China and Canada. And a lot of multiple pension funds and endowment funds are interested in this asset given it's risk-free. So we can expect a lot of capital coming into this industry, which favors it. In Slovenia, however, we've seen that there has been some inefficient utilization of resources, mostly because of the fragmented private sector. High costs in the public sector because as we analyze it, because of the way the concessions were structured, and there is some cost padding that is happening. And also based on some of the interviews that we conducted yesterday, we found out that the workers are not very well equipped with machinery, as well as are not very technical skilled to perform the work. So these are some of the factors that sort of bring the industry down a little bit. In terms of the environmental factors, given the felling rates are not very high in Slovenia and there is a lot of forest cover, we feel that sustainability as of now is not a problem, which favors the industry. The only issue is a lot of accidents that have happened, not just the snow in January, but also forest fires that have happened in the past and beetle attacks, which sort of is a problem that we need to consider. Other factors that we've seen political factors are very favorable. The government has been stable, and it's actually supportive of improving efficiency of the forests, which works well for it. And other support structures, as we observed from the case, the railway is very well supporting this industry in terms of connecting harvesters to the export nations, as well as the port terminals have been set up very well. So overall, we found that the industry, in terms of political factors and government support factors and other support structures, is very well supported. The only issue of inefficient utilization of assets and the costs is something that we need to consider.
So when we say, we did a SWOT analysis of the forest division of the fund, and we found out that the strengths that we have gained through 15 years of monitoring those concessional layers, we have had the learnings of how to manage those industry. So in case we start our own entity and we start managing our own forest, we will have a steeper learning curve in comparison to what we had 15 years ago. So right now would be a good opportunity. We have those necessary skills. In terms of opportunities, we have a 30%, we are the owners of the 30% forest cover. So when we are saying we are essentially the market leaders if we try to move into the industry. Plus, so this basically highlights that Forest Division Fund is now equipped with the right strengths and to tap the opportunities that were available, and they can take charge of the operations on their own. They don't have to necessarily go with the concession model.
Just quickly looking at the financial analysis of the current situation, we compared the Slovenia Forestry Fund with kind of three comparables. One of the two closest governmental agencies of Finland and Austria, and one sample small Slovenian farm for which we were given the data. As can be seen, the return on assets, so we calculated a return on per hectare in terms of euros per hectare of land. The Slovenian fund return has been abysmal to some extent and has been extremely volatile, more importantly. The public sector comparables like Finland and Austria have been performing decently well and have been performing in the 30 to 50 euros per hectare range. The very small, materially smaller Slovenian farm has a materially higher, almost 500 to 600 euro per hectare. It could be because of multiple reasons as low felling costs. We see the reason for the Slovenian Forestry Fund's low performance as a number of things like low utilization and inefficient operations, redundancy of costs as their costs both at the concession level and at the fund level, uneconomical historical contractual arrangements, which were the concession arrangements which were made in the 1990s, and potential monetary leakage due to financial mismanagement at the concession level and due to just not at the level of transparency which would be required.
Now that we've observed that there are some cost inefficiencies with the current concession model, we suggest three alternatives. The first one is doing a concession model again, but with restructuring the way the concession is done. So you do this time a bidding for the concessions, and so they'll bid, and the lowest one with the right technical qualifications actually gets the bid. And the way you take the concession fee is not a percentage of the bottom line profit, but of the top line revenue. So it sort of ensures higher profitability for you. The second one is actually converting the forest division of the fund into a public sector entity. With high capex investments, as in you invest money to buy more machinery, fellers, harvesters, etc., as well as you hire more people and train them to use that machinery. So this gives you more control across all your operations, and the decision making lies with you. Also, it will be The third one is you set up the public sector entity. Again, the forest division moves into this entity. But in this case, you don't buy more machinery, but you do tendering, bidding for certain operations. So you will do for one particular identify clusters, and for those clusters you do bidding for the harvesting process or the selling process, etc. Again, the control lies more with you because you will be designing, you will be deciding who gets what operations, and you will take the ultimate decision. We will be analyzing these three alternatives across 4 dimensions: how it improves efficient utilization of assets, how it improves the profitability of the fund and entity in the other cases, how it improves stabilization of the markets, and how can it support the broader economy, not just the public sector assets, but also help improve the efficiency of the private sector assets. So this is the matrix that we are looking at. So I'll just take you through each point. The first one, the first alternative, which is the new concessions, we see that there will be improved utilization of assets as compared to the current model, because this time the concessionaires are going to be bidding, so they would also want to be more efficient and they will try to be more low cost. So the efficient utilization will go up. The profitability of the fund will go up because you're getting a percentage of the revenues and not of the profits. So the problem of cost padding, etc. will be avoided. Stabilization of the markets, in the sense you will be more profitable, which gives you some more capacity to actually buy surplus produce from the private sector in case of volatility and uncertainty during the market. Supporting the broader economy, by supporting the broader economy, we basically are looking at if we can actually acquire some private sector assets, consolidate with our current public sector assets and improve the overall efficiency, particularly acquiring private sector assets close to our current public sector assets. here, because you won't have a lot of, you're not that profitable, you won't be in a position to start off with that thing. So that will be a negative here. The second one, which is setting up the public sector entity with high capital investments, efficient utilization of assets, because you are in control of those assets and you are taking all the decision rights, will be higher. But profitability will not be high because of high capex, and so you may not be profitable for some time. Stabilization of the markets, again, you won't have enough cash with you to actually be able to buy surplus, so you are not actually helping stabilization of the markets or acquiring any private sector assets. So that is a negative for this alternative. The third alternative, which is also a recommendation, is again, in terms of efficient utilization, you have the control rights. So you will be doing more effective utilization. Also here we are using a tender system for service providers, so they will also aim to be cost efficient. Profitability obviously goes up because you're not investing in very heavy machinery or human resource development. And because it's a tender system, you will have low costs, high profitability. Stabilization of the markets, because given you have that excess cash that you can use to buy extra produce in case of volatility. And also, here is the point where you can buy the small private sector assets, which a lot of private sector people are not handling very well, close to your public sector assets, get a larger area, consolidate, and actually be more efficient in terms of your fixed costs going down.
We quickly did an analysis of what each of these alternatives would look from a financial standpoint. The first one, which was doing a concession again and restructuring the agreement, we looked at comparables and saw that a 20% top line revenue cut would be comparable, would be efficient given their comparables. That would give a concession commission of starting at about 15 million going up to 19. And we looked at the fund's historic performance, and we found out that historically their operating EBIT was about 30-35% of the concession revenue that they got. So given that, we got the cash flows and we used a simple discount rate, which is about a 20-year euro area central bond with a 300 bips premium to reflect risk. Going on to alternative number 2, we used simple growth assumptions for both revenue and cost, and saw that based on the current acreage and if they maintain the same assumptions, we can do the total revenue generated through the 240,000 acres of assets can be in the range of 74 million growing to 96, and the operating profits would be 24 to 35 million. Looking at, because this is a high upfront investment, we estimated that you would need almost 30 to 40 million of upfront investment to buy all the fellows' equipment and the training to really get this off the ground. We used a much higher discount rate, as not only are you taking revenue risk in this scenario, you're also taking cost risk by doing all the operations in-house. The third and the most economical, as you would see, is that doing the public sector entity but outsourcing all the expenses. Here, the revenues are the same as the previous alternatives. Costs are slightly higher because obviously you'll be giving potentially a margin to the outside contractors, which is an outflow from your balance sheet. But as you can see, the discount rate will be much lower because each of the contractors will be on a fixed price cost basis, and you won't have any cost risk in your portfolio. As can be seen, establishing a public sector entity with outsourced operations provides the greatest long-term financial value generation for the government.
So when we are talking about, when we have compared the objectives, the strategic objectives that we wanted to fulfill, those are being fulfilled with the alternative of owning a public sector entity and then outsourcing the functions. But there are certain additional advantages, being improved export volume, increased capital leveraging by pension funds, because once we become more effective, our returns tend to be higher. These endowment funds such as Howard's endowment fund, other endowment funds would tend to invest in our industry, and hence we'll have those necessary funds to further grow. Also, we have a stable customer base in the sense the downstream industries such as wood processing and furniture, which have in the past shown indications of bankruptcy and cash flow problems. Since we will be a large player in the segment, these fluctuations will not be impacting us in the same way they will be impacting other private players. Talking about the road ahead, what we believe is from October 2014 to 2018 would be a period where very high active involvement of the pension fund, of the forest fund would be required. So first, in the first year, till the time the contracts actually expire, we can prepare ourselves in the terms of all the regulatory requirements, all the checklists that have to be mandated in order for us to form a PSU. Then once the contract expires, we can actually roll out these bids. But this time the bids would be decided on the clusters that we are able to formulate. So clusters would be formed basis the proximity and the terrain similarity, so that the costs are standardized. So this will actually help us in making the bid more smoother as well as timely completion of bidding. The next would be handholding of these the new concessionaire, the new outsourced team in terms of streamlining their operations. And then in the subsequent years, we can look at improving our operational efficiency more structurally by acquiring private assets which are adjacent to our public assets, and hence scaling down those fixed costs. And so our final conclusion stands that we believe that public sector entity with outsourced functions to carry out the operations would be satisfying all our objectives and giving us much more.
Thank you.
Thank you very much. Questions?
What are the main risks that you see for currently this project that you are suggesting, and your preferred solution?
So one of the important risks that we see is the existing concessions. They might not be very happy with it, and there may be some negotiation, etc. I mean, they may not be very happy, so we'll have to see a way of actually ensuring that that is not a problem for us. So that is one major risk. The second one would be again.
So the second one, if I might add, we will be scaling our operations. We'll have more economies of scale, but that economies of scale will also translate into loss of jobs. See, currently the forest industry and the subsequent industry employ about 12,000 to 15,000 people in Slovenia. If we are scaling our operations, we'll be more efficient. But that efficiency will also come in terms of the manpower, because it's a manpower intensive industry. So job cuts are always have a political backlash. So this operation might have that political hindrance that we need to cross.
You clearly recommend the option 3, if I understand correctly, this outsources. To whom would you outsource? Would it be existing concessionaires, or would be new? And if the new one would be also from abroad?
Yeah, so when you're outsourcing all the harvesting and other operations of the business, it could be a large part of it will be consisting of the 13 current concessionaires and other big players, potential big players, though not too many in the area. I'm sure even operators in the neighboring countries like Austria and Finland would be one of the prime candidates, targets to bid for these contracts when they're coming up. In the grand scheme, Finland has about 3 million acres and Austria has about 500,000 acres, and our public holdings are about 240,000. So the contracts are still big, but not that material in size. And seeing that between the current concessionaires who have the equipment and who have been doing the logging themselves, and including neighboring parties, we would be able to we will be able to bid out these service contracts.
So currently in Slovenia there are 70 firms which do the logging operations, but the majority of the end-to-end operations are done by these 13 concessionaires. So in a way, this will boil down to those 13 concessionaires in terms of bidding, because they'll have an added advantage of having those relationships as well as having those initial infrastructure requirements that are required in setting up the business. So yes, they will have an additional advantage, but since we are this is a growing industry, plus considering that we are the third largest in Europe, we will be able to attract the foreign companies from the neighboring nations.
What about on the sales side? What will such an organization do to provide for new customers, new market segments, or ensure even the existing ones? So you spoke basically only about the organization of what kind of operations you will outsource, but I'm interested in the other side, in the sales side of the timber harvested. How will you sell it? To whom?
Yeah, so I think the primary assumption is that assuming that the rate of harvestation doesn't go materially higher and it's kind of doing at the same level, the basic assumption was that the current timber is being sold through the fund and through the concessionaires, and that process continues. It's just the management of the process is just internalized and taken over by the fund itself. The fund will have to develop some capabilities to make sure that it has the necessary operations to handle and continue the operations of what the 13 concessionaires were doing currently. But given that there's no material increase in output, which need to be, additional buyers need to be sought out, the current buyers will continue, the relationships will continue, and the fund will continue to sell to those people who are currently buying the 1 million per year harvest, which the 13 concessionaires are doing.
Just to add to that point, a majority of our production is going to exports. So export as an activity does not require that intensive of a sales effort. It's more of a country raising a tender that we require such and such amounts to export. So in terms of sales effort, in terms of building a sales force capability, there would be requirements, but not to the scale of an industry which is more B2C based, not a B2B based company. Because it's a commodity.
So if I understand correctly, you would use part of the profits to buy the small fragmented public land, right?
Yes.
My question is that back of the envelope, what chunk of that 70% privately owned can you bring into the venture over the 5 years, if you have any calculations for that?
So we basically try to get their data in terms of locating where our public assets are and where the private assets are. That data was not publicly available. So in terms of clear-cut mapping about how much area will be acquiring from the 70% private share, that definitive number we will not be able to provide. But if we are talking about qualitatively, the rationale behind going this way would be to connect. If we have to
qualitatively is clear, but I was just interested in whether we can, from these profits that we would be able to acquire or bring in 3% or 30% or 70%?
Yeah, it totally depends on how the government mandates its mandate to division the profits. If the mandate is for a part of the profits to go to social causes like tourism, forestry industry backward, a part of the profits to go back to the general public fund of revenues, and a part of the profit to remain with the PSU for further investment. So a lot of that will be dependent on what share is left by the government within the PSU to really grow the business. And given that a lot of the private sector farms are 3 to 5 to 10 to 15 acres, given the scale of profits, the back of the envelope something we can do very well. It shouldn't be that difficult to at least start bringing in slowly as the cash flow grows and the government becomes more, the cash flow stabilized a good percentage of the really smaller ones into profit and increase their utilization and efficiency.
One more question. You talked about clustering. How many clusters did you see? I assume that would be regional clusters.
It would be regional and terrain similarity clusters. So if we are talking about mountainous ranges, about mountains, having timber harvesting over the mountains. So some terrains of them are usually inaccessible, and hence the cost of harvesting timber from there are usually higher. So we can form clusters which have higher standardized cost and similarity of terrain in order that the bidding process goes efficiently. Because if a bidder has to bid on two terrains which have very different costs, he will go on an average basis and he will be more inclined towards having harvesting opportunities in the areas where the costs are lower, so that he can make more profit out of it. So when we are making clusters which have standardized costs, his incentive of prioritizing where to actually harvest from would be lower.
But if you look at those 13 concessionaires today, they're in different regions. So how would you combine them into clusters?
Yeah, so what we basically thought was, before the tender system is done out for the bidders to come in and bid for the operations, there will be a public consultation process, and there will be consultation with industry experts and with the SFS, which is to really get an analysis and use our own internal management experience for the last 15-20 years to see what is the most efficient way to do this tendering process, whether it's combining and clustering certain areas together, or to the extreme end, whether it could be, after the analysis, that these 13 clusters just need to be tendered separately again, the operations. So through a public consultation process and a consultation with experts, including our internal government folks, as an implementation timeline set, there will be a process to really get the nuts and bolts into place before the tendering process is done.
Any more questions? I've finished, I think. Huh?
Yeah.
Okay, thank you very much.
Thank you.
Thank you.